You're listening to Capital Topics, episode number 78. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In our podcast today, we discuss if it's time to change your allocation to U.S. stocks. Enjoy! Good morning, James. How are you today?
I'm very good, François. It's the middle of the summer and the weather's beautiful. How are you?
Yes, it is. I'm good, thank you. So, I'll start. On our last podcast, we reviewed the performance of asset classes for the first half of 2025. Today, we're going to discuss a question we're getting from our clients, which is, should we reduce our allocation to U.S. stocks? As our regular listeners know, U.S. stocks have significantly outperformed international stocks, both developed and emerging, since the global financial crisis of 2008-2009.
Well, François, this is indeed a question that we get a lot in our client meetings. So far in 2025, international stocks have outperformed U.S. stocks. The question for many investors around the world is, how much of their portfolio should be international? So recently in the Wall Street Journal, there was an article by Randall Smith, and he quoted Gargi Chowdhury, a portfolio strategist at the BlackRock, which is one of the largest global institutional money managers. And the quote is, clients have been asking us how they should rethink their non-US portfolios. A lot of people have not really thought about this in the past few years. We, of course, François, have addressed this issue regularly in the last few years and many of our podcasts, including most recently number 75, when we covered the UBS Global Investment Returns Yearbook 2025.
Yes. Well, now that U.S. stocks have underperformed, everybody is wondering if it's the turning point. And with the chaos out of Washington, we instinctively believe or think the U.S. is not headed into the right direction.
Well, again, investors, as we've discussed many times on our podcasts, are always vulnerable to hindsight bias. That's true for professionals or individuals. And, you know, this hindsight bias has been extensively studied in behavioral economics. So it's fair to say that many investors would at the end of 2024, have had a big bias towards a high allocation to U.S. stocks, given the extended outperformance of those stocks, and that outperformance is staggering. So I've got some data here, François. According to Morningstar Direct, and this is all in US dollars, for the 15 years between 2010 and 2024, US stocks returned about 13.5% annually, compared with only 4.8% for international stocks. So that's like, you know, between 8.5% and 9% compound per year higher. Wild. And so, you know, that kind of overperformance, investors are going to want to be, you know, in that market. So again, the Morningstar Direct database they were using looked at the largest total market index funds in each category to come up with that data. But as we've discussed often and in our podcasts, is we want to have much longer term data series than that to make asset allocation decisions. So again, we recommend we always look to the very long term data to get a better picture of how to allocate.
Right. And the performance numbers you quoted, James, are in US. So I recommend our listeners, they consult our market statistics page to get the long-term performance comparison in Canadian dollar. We'll provide a link to it on our podcast page. But year to date, the numbers reflect the fact that the Canadian dollar gained 5.6% versus the USD. In the first 6 months of the year, developed international equities measured by the MSCI EAFE is up a strong 13.2% in Canadian dollar. In local currencies, it's up 7.8%. Emerging markets are also doing good this first half, with large and mid-cap stock generated 9.5%. Again, that's in Canadian dollars.
So considering the fact, François, that this international stock performance is very recent, And, you know, we've seen 15 years of U.S. equity market dominance up until the end of 2024. You know, it's sort of normal that many investors start to question the benefits of being globally diversified. Like, I could have been just 100% U.S. stock and been a genius. But really, this turnaround this year has been an eye-opener, which is why it's leading to a lot of investors asking, you know, should we be reallocating differently between American and international stocks? So market history, François, as we know, teaches us that with diversification, sometimes it doesn't pay off. There's always one bucket that may not be doing as well. But over the long term, you will get a better, more stable return.
James, I think we need to look at why U.S. stocks outperform over the last 15 years so our listeners can better understand why U.S. stocks have dominated.
Well, that's a great point you make, François. So let's look at that. In the Wall Street Journal I quoted earlier, it goes on to highlight really what's obvious is that the big 15-year performance gap includes, you know, an impact due to the rise in the value of the U.S. dollar against almost all other foreign currencies. And then the other big obvious reason, which is the dominance of in high growth areas such as tech, which includes the Magnificent Seven stocks such as Google, parent Alphabet, Amazon, Apple, Facebook, parent Meta platforms, Microsoft, NVIDIA, and then Tesla. So, and as I mentioned earlier, since U.S. stocks have massively outperformed, investors, they're going to chase that performance and have allocated more to U.S. equity than maybe they should have. But there's a flip side to all this outperformance, and that is valuation, François. The U.S. stock market is a lot more expensive than international stocks, even after this recent underperformance. Again, quoting from the Wall Street Journal article by Randall Smith, according to Yardeni Research, in the U.S., at current multiples of 23 times expected future earnings, there's a healthy premium to international stocks, excluding the U.S. market, at 14 times. So, and then that's based on market prices as of July 2nd. So again, U.S. stocks remain overvalued by many historical measures.
Mm-hmm. Yeah. It can also be said, James, that international stocks have not produced Magnificent Seven type companies to help drive returns. Some believe U.S. exceptionalism is at play here. The U.S. has a very well-developed early-stage venture capital and private equity market that other countries simply can't compete with. But James, do you have some insight to share about U.S. stocks market valuation and outperformance based on long-term statistical evidence?
Well, again, as I mentioned, and we always talk about, we want long-term statistical evidence.
Mm-hmm.
And there's a well-respected former academic, Anthony Ilmanen, who's now principal and global co-head of Portfolio Solutions Group at the AQR, the big U.S.-based quantitative institutional investment manager. And he published a report recently titled Exceptional Expectations, U.S. versus non-U.S. equities. And that was a part two to a part one report that he produced earlier. So this report came out in May of this year, and it sort of decomposes historical U.S. stock outperformance into three components: yield, growth, and valuation change. And it really addresses the question of the U.S. versus international allocation by analyzing the drivers of relative performance, in particular, the different roles of fundamentals and the role of valuations.
Mm-hmm. James, I like the fact that they highlight the debate in recent years among large global money managers in how to allocate funds to global equities, specifically the ongoing challenge they face of how to respond to persistent U.S. outperformance. The report states, and I quote, "Some global money managers maintain market cap weights despite even more extreme relative valuation. Others pursued the contrarian view implied by yield-based expected returns, and yet others gave up entirely on the rest of the world as the U.S. seemed so strongly placed to foster technological innovation, earnings growth, and investors' return.
The report highlights how U.S. outperformance, really going all the way back to 1990, primarily reflects richer relative valuations. And I quote, by the end of 2024, relative valuations were at a historically extreme level. And we argue that some mean reversion is a sounder assumption than simply extrapolation of further richening. So what they're basically saying is that, wait a minute, the fundamentals were better in the U.S., but it's really not that's not the big factor. It's that people were prepared to pay a much higher price because of higher future expected growth in the U.S. market.
Yeah. Yeah. For listeners, James, I would add that for the period of 2000 to 2010, the U.S. market had a lost decade and underperformed the rest of the world. That includes the financial crisis period. U.S. markets have also underperformed for other extended periods, for example, the decades of 1980s and the 1970s. That said, the report highlights, and I quote, the U.S. has enjoyed an average return and growth hedge over the past 50 or 100 plus years, though not as large as implied by recent valuations. We suspect that the recent high valuations and predicted abnormal growth hedge partly reflects investors mistaking the richening-driven returns outperformance for growth-driven outperformance, which would be more reasonable to extrapolate.
Well, François, again, one of the main findings of the report is that the U.S. stocks have a long-run growth edge. And I just want to make sure I pronounce this correctly. It's not hedge as in H-E-D-G-S. It's edge as in a differential. Totally. Okay? And better of around 1% per annum over the past century. And so this could be like the U.S. exceptionalism factor. But in recent decades, its return edge has been significantly boosted by relative pricing. And that's the key point. The long-run annual return edge is near 2%, but outperformance has been much larger since the global financial crisis, mainly reflecting relative valuation change, but also a larger growth edge and dollar appreciation. I now, François, I want to quote the report, the combination of using a short rear view mirror and ignoring the impact of valuation changes can make extrapolative investors form overly optimistic expectations on the future U.S. growth and return edge. Even the past decade's exceptional U.S. growth edge is not good news for the U.S., since both valuation changes and abnormal growth have negative autocorrelation at a decadal horizon. Subjective growth expectations are often extrapolative, but objectively, a strong decade of growth predicts a weaker decade again. There's a lot of jargon in that quote, François. Yeah. Is that what they're really trying to get at here is that the U.S. has outperformed significantly, and if we look at a longer term, like a decade or more, as a time horizon, that there should be a normalization, and that either U.S. equities are going to slow down or international stocks are going to sort of catch up, and the return differential we saw of almost 9% compound for 15 years up to the end of 24. Really don't expect that going forward.
Yeah. You should be expecting lower returns, lower expected returns from the U.S. going forward.
Exactly right. Because of how rich it's priced now.
Exactly. So to me, James, the main message is that the U.S. has had a long-run growth hedge of, say, 1%. The report also states that it is likely fair to assume some edge going ahead, but it seems that the markets are discounting a much larger growth hedge.
So that, François, leads to the question, how much larger? And so the in the report, they analyze that, and they try to sort of reverse engineer the question from another angle. And it looks at what growth edge would be needed over the next decade for the U.S. market to deliver the same return as the non-U.S. market, given how pricey the U.S. market is, and assuming no change in the valuation of either market. And the result, they're using AQR's capital market assumptions as of December 2024, is a required growth edge of 2.2% per annum for U.S. equities to earn the same return as international stocks.
Wow, that's a really important takeaway from the report. Also, it states that few investors appreciate how much of the past absolute and relative performance reflects repricing, which really should not be extrapolated, especially when today's extreme valuations point the other way. Rearview mirror expectation may be strongest just when they are most dangerous.
Well, I think that's an essential point that the report is making. So we need to remind our listeners that as Canadian investors, there's a compelling case for diversification within stocks. So, François, maybe it's a good idea you remind our listeners of our model.
Well, yeah, our model is 20% allocation to Canadian stocks, 50% to U.S. stocks, and 30% to international stock. The balance between the U.S. and international stock is in line with their share of global market capitalization. That works out to about 2/3 U.S. stocks and 1/3 international stocks for that 80% allocation.
Again, I would highlight, François, that we've always had a strong U.S. stock allocation. That market is just more liquid, better diversified. And again, it has that dynamism that no other capital market has with how they create large, innovative companies. So we've rebalanced over the years to maintain our weight. Some clients are now asking us, as I said at the very beginning, if we want to reduce this exposure. And the answer is that no, we don't. And again, this could be like a form of market timing or forecasting the future. But for some clients, I would add in particular circumstances, we can increase or decrease the weights of their allocations, again, relative to what our model is, based again, on specific, conditions.
Yeah. Finally, James, what takeaways do you have for listeners concerning global diversification?
Well, François, right now there's a lot of negative sentiment about U.S. stocks, particularly with non-American investors. We read a lot about global institutional, big sovereign funds, et cetera, moving money out of the U.S., given the chaos around the leadership in Washington. And as we like to do in our podcast, though, I'd like to ground everybody with some down-to-earth quote from Uncle Warren Buffett. And he said often over the years, never bet against America. By the way, he has said this often over the years. More recently, he wrote about his strongly held belief in his 2021 letter to Berkshire Hathaway shareholders.
James, in his letter to shareholders, he stated, despite some severe interruptions, our country's economic progress has been breathtaking. Our unwavering conclusion, never bent against America. Keep in mind that Warren Buffett also said the conglomerate owns the biggest amount of U.S. assets, that's property, plant, and equipment by value, than any other company in the U.S. So I guess we can say he walks the talk.
Absolutely. But that said, in his most recent newsletter, he highlights that he's been investing in the big Japanese conglomerates, the top 5 ones. So again, I think he's broadening out of the U.S. Another thought I want to share with our listeners, François, is also from our podcast number 75. Since 2000, when markets have been deeply volatile, they've tended to move together. But again, the potential risk reduction benefits from international diversification are very real. So it's in those moments of deep market volatility, read downside volatility, they all move in the same direction. But when you look at it like this year where things can move differently, so over time you see the benefit of that international diversification.
Correct.
So again, the potential risk reduction benefits from international diversification are very real. The UBS yearbook that shows data, going back 125 years. And then, in some other statistics that we looked at in our podcast number 75, it was over 50 years. The global portfolios generated higher Sharpe ratios than investing with domestic investments only in the vast majority of countries. So for our listeners, the Sharpe ratio is a measure of an investment risk-adjusted return. essentially it's indicating how much return an investment generates for each unit of risk taken.
Yeah, there's really nothing new here. As we often discuss in our podcast, diversification is a key part of our investment discipline. The power of diversification across stock markets and asset classes helps to reduce but not eliminate risk. Over the last 50 years, except for US-based investors, investing globally for investors led to better risk-adjusted return than investing only in their home markets.
François, I would add, as our regular listeners well know, we have experienced 4 equity bear markets since 2000, and we need to be paid for taking risk. We've said it before, the risk premium for investing in stocks exists for a reason. It's a necessary payment for the risk of volatility and drawdown. So, once you set that asset mix, you should stick with it, and that's the best advice we can give.
Yep. Good investment decisions are based on sensible criteria, and they can sometimes have disappointing outcome. This brings us back, James, to the importance of long-term perspective, and with it, an appreciation for the laws of risk and return. So I recommend our listeners always consider their long-term goals, their risk profile, their ability to take risk, and their time horizon when they build their portfolios. I hope our listeners have found this discussion about allocation to U.S. versus international stocks useful to help them make smart decisions for the long term. Investors must always come back to their perspective of risk and reward and the importance of diversification and asset allocation. So, as our listeners know, this is at the core of our investment philosophy. So on that, we'll conclude. Thank you, James, for sharing your thought and expertise today.
My pleasure, François, and I wish our listeners a nice, warm, and happy rest of their summer.
So that's it for episode number 78 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like your expertise in managing your assets, you can reach us by clicking on the Contact Us button, which is located on the Capital Topics homepage and on all our publications. Furthermore, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on September 3rd. In the meantime, make sure to consult the Capital Topics website for our latest blog posts. Thank you. See you soon.